Hey everyone, welcome back to the Dividend Growth Investing channel here. My name is Jake. In this episode here today, I'm going to walk everybody through a few things. Going to be talking about the concept of investing versus trading. Going to be taking a look at some of the greats in the industry and their opinion on the topic, as well as adding commentary to how I view this. The concept of investing versus trading. As well as I wanted to look at an individual stock here that's been in the news, as well as share my portfolio here with you as I've done over the last couple of weeks. If you're new to the channel, this is what I talk about. I talk about my journey to financial freedom through dividend growth investing. If you're new, I'm not a financial advisor. This is me just sharing my journey and my experience on YouTube, like many others that you might be familiar with. I'm a huge fan of the other content creators on YouTube. Some of them that you may know. There's PPC Ian. I think he's kind of the pioneer here on YouTube when it comes to this concept. There's others out there. Independent Investor, JMac Investing. There is a ton of others. I'm a huge fan of the Joseph Carlson show. I think Joe releases great content. You're going to see a lot of similarities in my approach. I admire Joe. I think he is also a leader in this, in looking at this, looking at it from, a YouTube perspective. I think he is really an up-and-coming content creator that's really under-recognized given the quality that he's producing. There's others out there that been around and have hundreds and hundreds of videos, but are not so up-and-coming like Joe and Joseph Carlson show. So what I try to do is I try to take and learn from other creators and kind of mold it into my own style. I really appreciate the time and effort that these other creators take in providing content for all of you and for myself included. And the approach that I've taken is, I've taken inspiration from them. I love PPC Ian. I'm an avid watcher and subscriber to him. I think the content that he comes out with is absolutely fabulous. Also, the Dividend Grinder, if you follow him, I think he's a great content provider. I know he's been getting a lot of hate lately in his comment section, and I think it's kind of taken a toll on him. But I'm really excited to continue watching him and really just sharing my journey and really just keeping it unbiased. I'm not affiliated with anyone. This is me here in my home in Texas, just sharing what's been working for me. And I've mentioned in previous videos weeks ago that this is really an experiment. I've never done this in this capacity before. I've more just been investing the traditional routes through TD Ameritrade. I've recently been using Robinhood, commission free. I think it's great. And so if you're new, this is new to the channel, this is what I talk about. And so, I'd invite you to subscribe and follow me on this journey and, hit that like button. It really shows the YouTube gods that the content is valuable and relevant, especially for the topic that I'm addressing here. So with that, I guess, I'll jump right into it here. What you can see on your screen, this is my M1 Finance account. I'm very transparent in what I do. I disclose pretty much everything except for my own personal information. I have the dollar amounts here, the percentages, everything that I'm doing, and I'm open to feedback. And I'm the first to say that my way is not the one and true way, right? And for those of you, maybe you're in Europe, you've heard this saying: there's many roads that lead to Rome. Right? There's many ways to financial freedom. There's not just one way. Some people preference real estate, others preference dividend investing, others preference side hustles and others. But this is my journey, my life, and I love sharing it. I've gotten great feedback from the community so far, and that's what's really encouraged me to continue sharing these videos here on YouTube. So what you're seeing in front of you, this is M1 Finance. This is my portfolio. It's my passive income portfolio. I'm really looking to, I've broken this down into two accounts, and if you've watched my other videos, you can see that. I have all of my qualified dividends or qualified investments here in my passive income account, and my non-qualified here in the real estate account. And I just thought that would clean it up a little bit. So that's what you're seeing in front of you. The gains here, if you've watched my last video, the returns are a little bit different. So when M1 Finance did their update here, it mixed up the returns. I think last week I was displaying over 60% return. They got that fixed. It would have been nice to be over 60%, but this is where we're at. So all time, we've gotten $162 in earned dividends. If you're familiar with M1 Finance or not, M1 Finance, these are earned dividends. It's not what has already been paid out, but it's past the ex-dividend date, so that's what you've actually earned, but it's not necessarily what's already been paid into the account. It's very important to note that. The market gains, huge. I mean, for me, I've only had this in M1 Finance for the last couple of months. For the last month itself, $800, just over $54 the last week. Now, if you watch my last video, this was down $350. Now it's up $450, and we've got just shy of $17 in earned dividends. So making some progress there. Looking at the activities here, I went ahead and I sold out of AGNC. Out of this portfolio, I couldn't transfer it. If I was able to transfer it within accounts, I would have through M1 Finance, but they don't do transfers like that. And for some reason, it's not showing up here. I don't know why that's doing that here. Let's see if maybe I have to reload it. I don't know why it's not showing up. But yeah, so I was unable to transfer AGNC from this account to another sub-account within M1 Finance. So I'm unsure why. Here we go. Now we can see it. So I sold out of this, purchased other securities within this account. And I actually made some manual purchases based off of a few companies that were down. I bought Verizon. I bought Johnson & Johnson. They've been in the news lately. They've taken quite a hit. And Sonoco Products. I've purchased them. And Genuine Parts Company as well. And lastly, AbbVie. I bought some more. I've been buying AbbVie every chance I can get. I put a couple $100 last week into AbbVie, so I've really been trying to take advantage of the dip with AbbVie here. And so if you follow other YouTubers, specifically around dividend investing and so forth, they've been talking a lot about that. All right, awesome. So this is what I've been doing. The portfolio here, what I've done is I've changed up a little bit the target allocation, not much since last week, because I transferred over some of my holdings from Robinhood. The weighting is a little bit off from the target allocation that I want to have here. So that's why here in the consumers, I have a lot of Coca-Cola, Kraft Heinz. Kind of bought that a little bit too early. Altria and Kellogg's I brought over, and also a little bit of Procter & Gamble from Robinhood. And so these other holdings have not been invested in because the slice within the greater pie has been overweight. And that is why. So I've still been waiting to invest into Tyson Foods, Cisco Corporation, and so forth. But that's the reason why. And I'm trying to get everything a little bit more equaled out so that I can take advantage of the automated rebalancing function from M1 Finance. And I don't know why the percentages here are going off. I have to restart here, or refresh. Okay, so that's what's been going on there. Somewhere that I've also been loading up quite a bit, because I didn't transfer a lot from technology, in the technology sector from Robinhood. So I've been investing a lot here, and you can see that I've been getting a lot of VGT, the Vanguard Technology ETF. For me, it's really difficult to predict what's going to happen in the future. I think I would consider myself normal. I don't believe anyone can predict what's going to happen in the future. But I think for me, technology is really an interesting industry. I definitely see a lot of growth, but dividend growth opportunities, I'm just unsure. And so I'm not sure which companies are like, you got IBM, you got Cisco. We can talk about, okay, is Cisco a technology company or are they a communication company? I see them as a technology company. You also got like Oracle and these others that are paying out a dividend now, but it's really hard for me to forecast what's going to happen in the future with them. So that's why I've thrown in this industry ETF into the portfolio. This is the only industry ETF that I have. All the others I have purely, for the most part, purely industry-based individual holdings. So, and you can see here in this slice, I have 3 ETFs. I got the QQQ from Invesco, DGRW. I've made another video on my favorite dividend growth ETFs. This is one of my absolute favorites. You can check out the video that I made on ETFs there. I'll make sure that I put a link in the description below if you're interested in checking that out. I mean, Apple, they're not paying a huge dividend, but there's definitely room for growth there. Visa as well, definitely a technology company. Microsoft, huge fan of Microsoft, and Intel. So Intel is the company that I was talking about earlier in the video that I wanted to really look into. So with Intel, they've been in the news lately with, they had their earnings, they beat earnings. We can go ahead and we can pull up this article here. So it rose as much as 3% on Friday after beating analyst estimates for second quarter earnings and detailing its $1 billion deal with Apple. So what they're going to be doing is they're going to be exiting the modem business, the smartphone modem business, which is really, really interesting. I think, focusing on what they do best. And I think with all the uncertainty going forward, what's going to happen in the market with the trade deal, with international relations with other countries, I think they're taking a step back and just focusing on their cash cow, like what they do the best. And I mean, I'm not here to really go into detail into the decision there. I mean, we can make an entire video on this, but I think it's exciting. I think with Intel, I'm happy that they're making a move. They're getting ahead of, they're not waiting until there's a market downturn. They're getting ahead of it. They're positioning themselves in the best position possible. So I'm happy for them. I'm excited. I'm a big Intel fan. When looking at them on Seeking Alpha and looking at their dividend safety and growth and history, it's kind of it's not the poster child of dividend growth, dividend growth holding, but I think there's a lot of potential. I'm a fan in the company. I understand it for the most part. I mean, every human being that owns a PC should be familiar with Intel. I would hope. And so looking at their track record, and once again, you've heard me say this before, past performance is not an indicator of future, performance. It's just not how that works. But looking at their dividend growth history, over the last year, they've grown their dividend, and this is just dividend, right? Just looking at the dividend, they've grown it over 7%. In the last 10 years, they've grown it 8%. So pretty impressive, especially for a technology company. Right, and the dividend growth, now they're by no means a dividend aristocrat. They're not even an achiever. They're not a king. A king would be 50 years plus. An achiever would be 10 years plus. But 5 years, I think what you can see here is they haven't necessarily grown it, but they have not slashed it. Right, so I think that's important. And there you have it. So, and also looking at the actual history, I think Intel is one of those companies that did very well during the Great Recession, right? They didn't cut their dividend, and I think that's important. They didn't raise it. Now, I always like getting a pay increase in my dividends, but if they're not decreasing it, they're a stable business, they have a stable business model, I'm still excited about it, right? And 7%, 8%, that's not, I mean, that's way over inflation. So if you're holding this for the long term, which is, the topic of today, investing versus trading, if you were to invest into Intel years ago, 10 years ago, you have had, versus just buying the dips, and I mean, you could try to time it, but timing the market, no one can do that. You might get lucky once in a while, but no one can do it consistently over and over and over again. That's why you hear from all these greats in the industry with, Charlie Munger with Warren Buffett and Jack Bogle. You hear me quote them a lot. Those three, I really can't get enough of listening to them, and I see them really as thought leaders and industry leaders in the space. And so that's my go-to and how I view everything and where I learn, where I'm getting my knowledge from, primarily, not just YouTube videos, but reading what they have to say about it and following them. Right. So on the topic of investing versus trading, I think everyone coming back again. Everyone can get lucky once in a while, and if you're always trying to time the market and buy only on dips, as long as you're not selling, I think that could work. I mean, if you're just leveraging Robinhood and you're doing it commission free and you're only buying it on dips, you could probably be successful. But in order to do that, I think you're going to need to be broadly diversified in that you're going to have more than just a couple of holdings. Because if you look at the core market of the S&P 500, we're at all-time highs. So it's really challenging to find bargains and stocks on sale. Okay, so that's kind of my take on it. And I think time in the market versus timing the market is fundamentally more important, especially when you're looking at your retirement. If you're looking at funding your Roth IRA or your 401k, timing the market is definitely more important than timing the market. And that's where we talk a little bit about, the dollar cost averaging. I mean, that's what we do with our 401ks, right? Every 2 weeks we buy into our 401ks through our paychecks, through our employers. And so that's what we do there. All right. Now, one thing that I wanted to share with you, talking about Jack Bogle or John Bogle. He goes by Jack. And Jack Bogle's perception of the market. Now, he was the founder of Vanguard, and he is 100% anti-trading. And there's studies that have been done that he shared that it's incredibly challenging to time the market and beat the market. It's better to just stay in the market and ride the wave. And depending on who you are, if you're in your situation, either dollar cost averaging or, investing everything and not waiting. So, but that we can talk about that on a different video, talking about dollar cost averaging. But with Jack, he was very skeptical of the ETF. So first, we had the index funds through Vanguard, and then all of a sudden we got all these ETFs. There's over 2,000 of them today. And Jack talks about, very harshly about them, that these are kind of one of the biggest threats to the retail investor is over trading. And he talks primarily about these more common, more established brokerages where they're charging a fee for every trade. So this is what he's really focusing on. I think down the road this may change, especially when Robinhood and others like M1 Finance become more popular, and you're getting commission-free exchanges or trades. But just talking about trading in general, especially around ETFs here, it's really interesting to hear what Jack has to say about actually trading.
And ETFs have brought brokers back into the picture. And guess what brokers do to make a living? They trade. Nothing illegal about that. But every piece of data that's ever been produced says that trading is the investor's enemy. The more you trade, the less you make.
All right. So the more you trade, the less you make. I think that is really, really interesting from Jack, and I agree with it. I think over the last couple of years, I've when I was first starting out to invest and to trade when I was in my early 20s, I didn't understand the risk that I was taking on with that approach. And so when really understanding, okay, when I'm trying to build wealth and trying to build passive income through dividend growth investing, I'm never going to get there focused solely on trying just to trade. And what I mean by trade, I'm talking about buying in and then selling. buying in and then selling. And now I know earlier in the video I told you all, okay, I sold a holding, but I'm actually buying in into another account, and so I'm not doing that every single day. So that's not what I'm talking about here. I'm not talking about that. And when you look at this, cryptocurrency and the new thing, what's in and what's trending, that's what I'm talking about. And I don't believe that that's the path to success for dividend growth investors. And that's why I thought I would, touch on it today. And I think investing and timing the market is going to greatly outperform trying to time the market and buy solely just on every dip and getting in and out of the market. Even if you have a platform like M1 Finance or Robinhood that allows you to trade commission free, I still believe that you're going to have diminishing returns had you have just stayed in the market and rode the wave, right? So that's everything that I wanted to talk about on this video today. Thank you everyone so very much for watching. I really appreciate it. It means so much to me when I hear your feedback, when I see your comments in the comment section, and hearing from you. It really excites me and encourages me to keep going and keep sharing my journey here on YouTube. And if you liked the video today, please go ahead and hit the like button. If you enjoyed the content and would like to be notified of future videos, go ahead and hit that notification button, and please subscribe. And I will catch you all in the next video. Thanks everybody. Bye-bye.